Hello, everyone. This is FECC, the European Association of Chemical Distributors in Brussels. I'm Dorothee Arns. I'm the Director General of FECC and your host of today's session on building resilience in an oversupplied world, which I am happy to host together with two long-standing and very nice ICIS colleagues, Will Beacham and John Richardson. And we have 1 hour to get amazing insights from their long-standing expertise. But before I introduce the speakers of today in more detail and also the topic, let me quickly tell you who FECC is, because we have a mixed audience out there. So why are we so interested in this topic as the European Association of Chemical Distributors? Well, FECC is the only European association representing the entire portfolio of chemical segments, literally from one side of the chemical value chain, starting with fuels and petrochemicals, to exactly the opposite side, I would say, which brings us to life sciences, which we define as cosmetics, food and feed, and pharmaceuticals. We cover all company sizes, from innovative startups to big multinationals. We perform all chemical supply chain functions. And a lot of our members, actually the vast majority, are small and medium-sized enterprises, and in many cases even family-owned businesses. So in total, we represent more than 1,600 companies via direct membership and via national associations. So that is us in a nutshell. And here in this slide, you see a quick overview of the major functions that distributors perform, but that is, of course, not all, because distributors take more and more functions over, and these are warehousing, recycling, formulation, and blending, research developments, technical and regulatory advice, and also logistics and packaging, but there is way more out there. So this is just the first flavor. And without further ado, some housekeeping remarks, which I cannot spare you. So first of all, since we are a European association, we of course ensure that this webinar is held with due diligence on competition compliance. The do's and don'ts, I think, are well known. Of course, we will not talk about prices, not about specific customers, and be compliant at all times. And a big request to all of you out there, please make this webinar as interactive as possible. It should not only be the speakers who will do a presentation of 40 minutes or so, but at the end, the last 10 to 15 minutes are yours. And we hope that you send us a lot of questions in via the Q&A button that you will find on your dashboard. I think MS Teams is meanwhile well known. So if you type in your question, then it will come out with us here in Brussels. And I'm happy that I'm joined with Nina from the FECC team, who runs the show in the background. So we will receive your questions, read them out anonymously, and then ask John and Will to answer them. Please don't wait until the very last minute, because it takes a little bit of transaction time before your notebook sends the question to my notebook. And we don't want to lose any insightful question at the end. And last but not least, before we go into the topic itself, quick remark that the slides will be shared. So thanks to John and Will for making them available to us. And as a little extra service to all of you, and following a flurry of requests, we will also record this webinar and make it available to all of you after the session. So this was the part on housekeeping remarks. So I think I did my job now. Now it's time to leave the floor to our dear speakers of today. One is Will Beacham, Deputy Editor, ICIS Chemical Business. And the other one is John Richardson, who is the Senior ICIS Consultant for Asia Pacific, especially China, but also Australia and New Zealand. And he's actually also based in Australia, so we are truly global in our webinar setup. So, warm welcome to both of you, Will and John, and we are looking forward to your presentation. The floor is yours now. Thank you.
Thank you so much, Dorothy, for that introduction. Yes, I'm Will Beacham. I'm ICIS Chemical Business Deputy Editor. So we are a weekly magazine, which is kind of like a roundup of everything that you need to know about the chemical industry, news and trends, and it's global. And I'm part of the news operation. We have ICIS News, which is a web-based news service. And I'm based in Ibiza in Spain. I've been writing about chemicals for about 25 years. I'm going to set the scene, first of all, by describing how Europe's petrochemical sector has fallen into its current crisis. Then I'll give you some perspectives on how the industry is responding to ensure its long-term survival and other strategies for success. Next slide, please. Okay, so here's the agenda. First of all, I'm going to look at what's driving Europe's commodity petrochemicals crisis, things like high costs, low demand, overcapacity and geopolitics. Then I'll examine the impact of these trends on the industry so far, and I'll show you by how much it's already shrunk. And then finally, I'm going to examine how CEOs and business leaders are reacting and developing strategies to ensure their future success. Next slide, please. Okay, first I'll describe how Europe's cost position shifted in the aftermath of Russia's invasion of Ukraine in February 2022. European business and political leaders decided to cut down on purchases of Russian oil and gas, particularly piped gas, and Russian gas flowed through Eastern Europe and into Germany, where it gave Europe's industrial and chemicals heartland access to plentiful supplies of competitively priced gas. As gas-consuming companies turned away from Russia, they were forced to source LNG instead at full global market prices. But the lack of LNG infrastructure, combined with a cold winter and insufficient storage, tipped supply and demand way out of balance. Prices spiked to completely unsustainable levels. And since then, as you can see, they have moderated, but European industrial gas prices, that's the blue line, remain 2 to 3 times higher than major competing regions such as the US, which is the green line, and the Middle East, the yellow line. The EU says it wants to phase out the use of Russian LNG and piped gas by 2027. So natural gas is used by petrochemical companies as a fuel to create heat, electricity and steam, but for other processes, especially for methanol, ammonia, caustic soda production, fertilizers, they use gas as a feedstock, and in these cases that can account for more than 80% of production costs. Next slide, please. So here's the latest ICIS forecast for European gas prices up to 2029. So gas prices spiked considerably this winter thanks to cold conditions, low storage levels and tensions between the US and Iran, but they are expected to trend downwards in the midterm, pressured by a surge of LNG imports as more US and Qatari production volumes are set to reach markets in the second half of the decade. This should be good news for Europe's competitive position, but it's unclear if prices will fall far enough to bridge the gap with the other regions. Next slide, please. So now I'll have a look at the demand side. In the aftermath of the pandemic, rising prices and interest rates have put consumers under a lot of pressure. Although both inflation and interest rates have moderated, this is yet to feed through to consumers. European GDP is forecast to grow by an anemic 1.1 to 1.5% this year, while inflation will be around 1.9%. But the cost of living crisis is still very real for a lot of people, causing them to hesitate about making big ticket purchases, such as buying new homes, autos and electronics. And this has caused a real drag on demand for chemicals, depressing prices and margins, while mainly China-driven overcapacity capacity situation even worse. As a result, industrial activity has been stagnating or even contracting in all the major regions since 2022, as these purchasing manager indices show. However, the January figures, which were released just last week, showed a surprising jump in US manufacturing confidence. The US ISM PMI index, that's the blue line, jumped 4.7 points to 52.6. That's the first expansionary reading, that's over 50, that's the horizontal black line, in 12 months. As an initially reported expansion in February, 25 was revised to neutral. But this was preceded by 26 consecutive months of contraction. US and European manufacturing, and China as well, have essentially been in either flat or in recession for just over 3 years. The US reading was not only the highest since August 2022, but it was broad-based, with a significant improvement in key sub-indexes such as new orders, production, employment, supply deliveries, backlogs of orders, and new export orders and imports. There were also marginal improvements in China and the Eurozone. But you might remember we had a very similar optimistic start to 2025 before the tariff war put paid to that nascent recovery. So let's hope this year will provide less volatile conditions and allow an economic recovery to really kick in. Next slide, please. So the impact on Europe's petrochemical sector of that triple whammy of low demand, rising costs and global oversupply has been devastating. Here we can see the historical trend in terms of European olefins production since 1990, taken from the ICIS supply and demand database. The trend has been downwards since 2027, but it really accelerated in 2022, that's the red line, after Russia's invasion of Ukraine triggered the current petrochemicals crisis. Europeans' olefins production this year is set to be the lowest since 1993. And there are fears that as more pieces of the petrochemicals jigsaw are removed from the board, the region's highly integrated petchem sector will become more fragmented, less efficient and more reliant on imports. Now that ExxonMobil has shut its 830,000 tonne per year Fife ethylene plant in Scotland, we now have almost 6 million tonnes of ethylene scheduled for closure or other strategic moves in Europe. The question on everyone's lips is, who's next? Well, so far, 9.2 million tonnes globally has been affected by the overcapacity problem. Next slide, please. I'll just put this one up because this is a really powerful graph which shows how China has come to totally dominate the global petchem sector. I'm sure John will talk more about that later. Rising to just under 46% of global capacity in 2025. It's astonishing to see how China has grown so successfully in the chemical space in a period of just 25 years. It makes growth in the Middle East and the US look quite insignificant on that graph. Next slide, please. This is my go-to chart to illustrate the global overcapacity issue. It shows global capacity exceeding demand in the 6 petrochemical building blocks. Wave after wave of new capacities come on stream, mainly in China, just as demand had slumped in most major economies. This unfortunate mismatch between supply and demand has grown from 184 million tonnes in 2025 to reach a forecast of 226 million tonnes by 2030. And of course, the Middle East will also add a lot of crude oil to chemicals before the end of the decade. Next slide, please. So let's move on to solutions. How can chemical producers adapt to these conditions and even thrive? So here's the first strategy. As I mentioned earlier, here is the number one strategic move which many chemical companies have adopted since 2022. When the odds are stacked against you in Europe, many CEOs are now taking a very close look at their assets from a cost and demand perspective. This has resulted in an unprecedented wave of capacity closures across the region. The latest figures gathered by ICIS show that 9% of the region's chemical industry assets are either closed or under review for shutdown or sale. In this oversupplied environment, business leaders are doing their best to focus on products and geographies where their companies still cut a competitive edge. Next slide, please. So this chart shows shows us how the wave of closures looks globally, and it shows that it's not just Europe that suffers from high costs. Anywhere with a naphtha-based feedstock and older or unintegrated plants is at risk. In Asia, for example, South Korea's government is working with the petchem sector there to come up with a closure and consolidation plan for its cracker network. And just a couple of weeks ago, 3 Japanese producers signed an agreement to create a joint operating entity, which includes the closure of a 500,000 tonne per year cracker by fiscal 2030. For the big global players such as Dow, though, the focus of closures has been on Europe, and that's the forecast for the second half of 2028, with the big focus on Europe for the closures. Next slide, please. Okay, so to support a thriving and profitable industry, operating rates need to be much higher than they are today, as they become depressed by the global overcapacity crisis. ICIS analysts have calculated that to increase global ethylene operating rates back to a healthy long-term average of 85% by 2030, around 21 million tonnes of ethylene capacity will need to close. To put this into perspective, Europe's current ethylene capacity is also 21 million tonnes. Europe already has 6 million tonnes of planned closures, sale or other strategic moves, so we can see how CEOs are already working hard on this most important method of self-help. Next slide, please. So here's strategy number 2. You might have noticed that a new pattern of chemical plant ownerships emerging, especially in Europe, where high costs and low demand and the looming cliff edge of a more stringent emissions reductions targets by 2030 are driving players to take a hard look at selling some production facilities if they can find a buyer. This tends to work out much cheaper than closing sites, especially older ones, because of redundancy and the cost of decontaminating the land. However, as I'll show, sellers are being forced to more or less give away these facilities. These distressed asset sales have led to increased interest from investment funds specialising in special situations, banking on low-performing assets becoming more competitive as the market cycle shifts. Next slide, please. So the largest gamble by turnaround players in the chemical space was the purchase of SABIC's European petrochemical portfolio, as well as a raft of the company's Americas-based thermoplastic assets by 2 Germany-based firms, Akita and Mutares. So the Mutares sale is expected to close by the 3rd quarter of the year, while the Akita sale deal is expected to be concluded by the end of 2026. Akita's purchase of SABIC's Europe Petchems business is for an enterprise value of $500 million, but Akita pays very little upfront because the deal will be settled based on future cash flows, with a minimum guaranteed earnout of $70 million within 4 years of the 2nd anniversary of the deal closing. So Akita has had little chemicals exposure before it agreed to buy LyondellBasell's polymer assets in mid-2025. So with these combined assets, plus the SABIC deal, Akita now has LDPE, low-density polyethylene capacity, of over 1.1 million tonnes per year, plus 300,000 tonnes of LLDPE, which could make Akita the largest producer in the region. The deal also includes around 1.5 million tonnes of polypropylene capacity. SABIC told a Saudi newspaper that the divestments will save it $4 billion in potential future losses and $5 billion in shutdown costs. SABIC's own data on its European assets show that the business has operated at a substantial net loss for several years. So the combined assets give Akita a substantial footprint in Europe for a low price, meaning that an uptick in fortunes in Europe could net a return, especially if a lot of other assets have closed, leaving a capacity gap in the region. We don't know anything about Akita's plans for these assets. They've not granted anyone at ICIS, me included, an interview so far. Next slide, please. So the spate of trade deals struck by the EU in recent weeks should be good news for chemical companies. And here's strategy 3, tariffs and free trade agreements. For any chemical companies that want to enjoy zero or lower tariffed trade with fast-growing regions. But it's too early to celebrate until we fully understand the details. Since the start of the year, the EU has struck major free trade agreements, FTAs, with India and the Mercosur nations, that's Brazil, Argentina, Paraguay and Uruguay, as the region accelerates moves to diversify its trading partnerships amid the US tariff turmoil and rising geopolitical instability globally. Whilst the Mercosur deal is now mired in legal uncertainty, the EU-India deal looks set to enter force next year, once it's been translated, checked and ratified by the European Parliament and the Council of Ministers. On the face of it, the EU-India deal could be great news for more free flowing of chemicals trade. Tariffs are set to fall to zero for most chemicals in a combined market of 2 billion people and close to a quarter of global GDP. EU exports of plastics, which were worth 2.2 billion in 2024, will see tariffs falling from up to 16.5% to zero for most products. For 3.2 billion in chemicals exports from Europe, tariffs will fall from up to 22% to zero for almost all products. Tariffs in the other direction are lower, with the EU charging tariffs of up to 6.5% on commodity chemicals under the WTO's Chemicals Tariff Harmonisation Agreement, and these will fall to zero under the FTA. As domestic production of commodities decreases, there could be opportunities here for distributors to fill the gaps too, especially once we start to see demand recovering in Europe. The EU exports substantial quantities of base oils, plastics and polyvinyl chloride to India, as this graph shows, while purchasing polyester films and fibres. Volumes in either direction are limited, but they could be set to increase over time. So India's a low-cost region for manufacturing compared to Europe, and it's trying to diversify its economy. So exports of chemicals and finished goods flowing from India into the EU could threaten domestic business if it's successful. Europe will need to export products which really appeal to the Indian market on brand, quality, design and function rather than price. India has ambitious plans for its chemical industry, which fit in well with its push for self-sufficiency. Indian cracker capacity is set to see a 92% increase from 26 to 2030 to 2040 rather, with ethylene forecast to more than double, including unconfirmed products, according to our supply and demand database. However, anti-dumping duties are not affected by free trade deals, and these remain in place. So the devil is in the detail, and we don't yet have a full picture on these FTAs. There are unanswered questions about other non-tariff barriers to trade, which could still impede trade between these FTA partners. Customs procedures, rules of origin, intellectual property, these will determine how effective FTAs like these can be. In India, for example, chemical exporters have faced bureaucratic hurdles such as quality control orders, which are licenses for specific products. Onerous customs procedures can cause administrative barriers, which increase the cost of trade significantly. Next slide, please. So, after 2 years of watching European industrial value chains gradually disintegrating, on February 2024, 73 industry leaders spanning 20 industrial sectors presented the Antwerp Declaration for a European Industrial Deal. So now I'm talking about strategy 4, political pressure. They presented this deal to European Commission President Ursula von der Leyen. This was followed in May that year by Mario Draghi's report, The Future of European Competitiveness, in which the former European Central Bank President and Italian Prime Minister laid bare the competitiveness crisis facing Europe while giving recommendations to tackle the situation. Unfortunately, not much has noticeably improved for industry since then, although a plan called the Clean Industrial Deal was launched in February 2025, which was full of good intentions. Industry leaders have become increasingly vocal about the need for greater deregulation, protection against global overcapacity, and support on energy prices. And this week, 2 years after the first Antwerp Declaration, look out this week for news in the media of the Clean Industrial Deal, as industry leaders will meet EU leaders once again in Brussels to urge swift action, in Antwerp, to prevent further erosion of Europe's industrial backbone. Chemical distributors and producers can get involved in political lobbying with a clear message that actions speak louder than words. Next slide, please. Strategy 5, more regulatory pressure. Again, another technique to protect domestic chemicals is the rising tide of anti-dumping duties, or ADDs, and other trade measures aimed at reducing the flood of cheaper imports, particularly from China. Individual companies can appeal for these to be imposed. For example, late last year, INEOS prepared 10 major anti-dumping cases to protect the essential chemicals that it said form the backbone of Europe's automotive, defence, electronics, construction and packaging industries. These included polyvinyl chloride, acrylonitrile butadiene styrene, ABS, monoethylene glycol, MEG, and polyolefins. However, ADDs are a blunt instrument. As this example shows you, when duties are imposed on one nation, other countries tend to increase their exports to the EU. Here you can see the effect of ADDs against imports of epoxy resins from China. That's the red area. Taiwan, which is the purple shading, and Thailand, which is the pink. The dotted lines show you where investigations were started and then duties imposed. And in this case, you can see epoxy resin imports from South Korea, which was not included in the ADDs, rose 30% year on year. So the overall level of imports actually increased. And we've done a similar analysis for other products at ICIS. Next slide, please. Finally, I'd like to mention more traditional methods of ensuring your company's future success: innovation. I chair the ICIS Innovation Awards judging panel, and every year I'm really impressed by the commitment of chemical producers and distributors in understanding and innovating to meet future customer needs. It's a long-term commitment, but one which will help not just your company, but the entire chemical industry to secure its future. Most process and product innovations now tend to help customers reduce their carbon intensity or to find new ways to improve efficiency, for example, through AI. There is a trend in Europe towards more specialized materials, which are less impacted by high energy and raw materials costs. That's it for me. Thanks so much for listening, and do get in touch via LinkedIn to discuss any of these issues. Over now to John. Thank you.
Will. Right, if you go into the first slide, which shows the contents of what I'm covering. Thanks, Nina. So I'm going to talk about the downturn that Will referred to, what's causing it. And you mentioned China. I'll go into that a bit. China's demographics are terrible, really, really bad. I'll talk about global demographics in that context as well, just to broaden it out a bit. But it's really all about China, the end of the real estate bubble, and demographics. And I'll show you some data on chemicals and what that means, and what it would take to get back to normal. The chemical super cycle, which was from 1992 to 2021, using propylene as an example. And Will talked about consolidation at a global level. There's going to be an awful lot of consolidation to get operating rates back to normal. The good news, and Peter Vanacker, the CEO of LyondellBasell, was talking about this on an ICIS news story the other week, is China's anti-involution policy, strange phrase, but that's about consolidating, closing plants down, and that's it's happening elsewhere. That it gets sense that's accelerating. So it may not be as gloomy as some of our data looks. One of the interesting things about the trade war is the fact that the Southeast Asia is one of the regions that's benefited. As direct China-US trade has declined, Southeast Asia has been booming. There are challenges to that, but that's really important to understand about the trade war, transshipment, rules of origin, how that could affect regions like SEA. And then finally, I'll go into three mega trends that I think are shaping the long-term future. Of course, I've got to talk about AI right at the end. Next slide, please, Nina. So this is a slide I've been using for a few years now, and it shows per capita resins consumption, the 9 big synthetic resins divided into 3 mega regions. So we've got China itself as a mega region. the developed world, listed down the bottom there, and the developing world outside China, much more populous, the most populous region of the world by far. And you see the green line is China. You see this extraordinary growth in per capita consumption. Now, the first thing you'll probably say is not every Chinese person is consuming these resins. Absolutely not, because a lot of it is being imported, be re-exported, or domestic production these days, as Will was talking about, for export. But it shows the way that China's dominated global demand over these three stages of history. So 1992 was Deng Xiaoping's Southern Tour, economic liberalization, taking advantage of youthful populations, moving to the coast. Very youthful population there, and lots of state investment in manufacturing. Bang. The big bang was that China joined the World Trade Organization, where the tariffs and quotas that had restricted Chinese exports to the West were removed. So China could take full advantage of its demographics, its export-focused manufacturing, without any quotas, without any tariffs. And you see that the inflection point of that green line as it takes off. And then this massive economic stimulus package post-global financial crisis in 2009, it really took off, the point where it's overtaken the West. And the Evergrande turning point is the end of the real estate bubble in August 2021, when everything started to change. So next slide, please, Nina. And here I've put it in millions of tons rather than per capita. And it's extraordinary when you look at down the bottom, the same 9 synthetic resins that in 1992, China was 22% of the global population, 9% of demand. End of last year, sorry, I need to update this for 2026. It was 18% of the global population, 41% of global polymers demand. Look at one line to developing world outside China, 68% of the global population, 32% of polymers demand. Developed world's not going to grow much, is it? It's pretty stagnant. For the future of the developing world outside China. So it's staggering numbers. And really the problem we face is since the Evergrande turning point, demand growth in China has been below expectations. And capacity was added on the basis of much stronger demand growth in China than has been the case globally. That's the problem. People expected a demand growth of 6 to 8% a year in China across the petrochemicals in general, more like 1 to 4%, because of the Evergrande turning point. And the next slide, please, Nina. Demographics, because of this, which is a slow build. Obviously not since just 2021, this has been building for decades. This is from our colleague Kevin Swift, our economist at ICIS. It's staggering. The blue line is his dire demographic scenario, but the population falls to just 373 million by the end of the century. Even the base case is just over 700 million from 1.4 today, because of the one-child policy, rapidly aging population. As Kevin talks about, the addressable market for chemicals keeps shrinking now, right? And there's no way you can turn this round without mass immigration. And on a scale we've never seen before. That's going to be very, very difficult. So you can't really get away from these demographics. And so that means China's going through a lower growth for longer period, compounded, as I said, by the end of the real estate bubble. And the next chart, please, Nina. And just broaden it out. Right. So China is poor and aging, right? Like Russia, but China's much more important for chemicals demand, as we've seen, than Russia. So it's poor and aging. It doesn't have the welfare state that some of the wealthier countries have to pay for pensions and healthcare. Very poor welfare provision in China, which is a real problem for domestic spending. The poor and young is where the future is. I mean, Will mentioned India, Indonesia, Turkey, Brazil, etc., Mexico, Argentina, South Africa. You know, they've got a lot of potential if they can cash in on their demographic dividend. And then we have the rich world, rich but old. Most of the European countries, Australasia. Saudi Arabia is young and rich, so it sits outside the boxes, but it's not really important for chemicals demand. Of course, it is for chemicals production. But these trends have been very, very important going forward the next 20, 30 years in shaping the nature of chemicals demand. That's a broader topic we could come back at a later date, but I thought I'd give you that context of demographics being so important. Next slide, please. So let's get to nitty gritty of what's happening in the chemical industry now. And this is propylene. Now, between 1992 and 2025, Most of that time was what I say the chemical super cycle, which is 1990 to 2021, but I extended it out to 2025. Average global operating rates for propylene were 80%, right? We forecast just 72% right out to 2036. So in an imaginary world, how do we get back to 80%? And that's my orange line. I get back to 80%. So our base case is 72% average. What it would require would be for capacity growth to be only 1.5 million tons a year versus the ICIS base case of 4 million tons a year. So just think about that. 1.4 million a year of growth of propylene capacity versus 4 million tons a year base case. And you get the operating rates by dividing production by capacity. So I manually, randomly just kept reducing capacity growth until I got back to 80%. Of course, this is not right. It's just a concept, but it gives you an idea of what would have to happen. And production is the same as demand. So we see production growing at 2% per year. Don't see a major upside for demand over the next few years, certainly. And right out to 2036, as I said, we've got another 11 years of very challenging market conditions in theory. And we know that China will probably carry on building. Yeah. Certainly big integrated modern plants, although it may be closing older plants down. We know the Middle East will carry on adding capacity. So we're thinking here, of course, of Europe, as Will mentioned, and South Korea and Southeast Asia, where the bulk of the closures will have to happen to prevent this from happening, right? I don't think the industry can tolerate 72% out to 2036. It can't happen. I think the correction will be quicker, but it just shows the extent of what has to happen to get us back to normal. And next slide, please. And then the anti-involution policy, this strange phrase that I mentioned at the beginning, it's aiming to curb overcapacity across many industries, right? Not just chemicals. They want bigger and larger integrated plants, more efficient plants. So some refinery-based propylene plants in Shandong province will finally close down. Your smaller PVC plants for environmental and economic reasons will go. And then you'll concentrate on, I think it's 7 big integrated chemical sites in China, just 7 sites, right? Super sites, very efficient, like the BASF complex that they're just building or finished building, the Shell complex, etc., ExxonMobil, these giant joint venture complexes, super efficient, very modern, very competitive, and the older plants will go. Question is how quickly and how much of that capacity will close down. As I said, Peter Vanacker was interviewed by my colleague Joe Chang last week. He thinks 3.7 million tons of ethylene capacity will close in South Korea, 5 million in China, and Southeast Asia 3 million, with another 1 million tons of announced closures yet to be sort of really firmed up in Southeast Asia. So that's quite a lot. And combining with the anti-involution, we'll have to wait and see. I mean, this year I think will be the turning point in capacity closures. I think we'll see quite a lot of drastic action. It has to happen. Next slide, please. And then we've got to think about the trade war, the lot of noise and the fury of the trade war, which sometimes it hasn't amounted to much in real terms because a lot of the tariffs have been compromised on. But what we do know is there's been a steep decline in direct China-US trade. We know that from the data. And we do know that what's been happening is a lot of components from China have been going to Vietnam, to Mexico, to Turkey, etc., Indonesia, India, to be processed and turned into finished goods to be exported then to the United States. And we've seen strong growth in Southeast Asia in polymers demand. In chemicals markets been very good, much smaller than China, but it's been a bit of relief because of this rerouting of trade. So I advise, if you're selling chemicals or polymers into, say, Southeast Asia, watch out for how this could change. Watch out for transshipment and rule and origin audits. Is the US going to clamp down on this? The rules of origin. Where do your components come from? Will you see end users starting to hedge against the risk of maybe not buying components from China anymore, not polypropylene from China, buy it from South Korea instead? And if you're selling into these markets, should you be aligning yourself with the end users who are hedging against this risk? I think that's very important. FDI announcements are important, of course, freight rates, anti-dumping, countervailing. Will again mention anti-dumping, countervailing duties, all very important. That could change the outlook for these regions like, well, Southeast Asia, Turkey, Mexico, that have really benefited from relocation of manufacturing or finished goods manufacturing from China. So it's very, very important, very complex, but it's really need to focus on this as a distributor or a producer of chemicals as well. Next slide, please. And on to my mega trends, and we'll take some questions at the end. I think one of the key mega trends is China being good at everything, right? Not just the low value stuff, but the high value stuff as well. Will they end up being really good at green chemicals or petrochemistry? The intelligence suggests that will be the case. It's very, very good at solar panels, the electric vehicles, as we know, with BYD, it's a global brand now, right? It throws lots of government money at the problem, lots of innovation, floods a lot of funding, pours into innovation, and some of it's wasted, a lot of it's successful, right? They dominate rare earth metals, solar panels, EVs, windmills, etc., etc. At the exclusion of a lot of Western producers have been squeezed out. And we're seeing a lot of interesting investment in green hydrogen, if that's going to work, or power to X, as we call it. Hydrogen, methanol, ammonia plants, right, in China. Huge investment. Those 7 sites I was talking about, they've all got to have CCS, carbon capture and storage. So electric crackers, reusing CO2. That's part of the plan for these big integrated chemical sites. And you know what you mean, we're talking about now, if they could export chemicals to Europe and beat the CBAM, that could be the thing. As they get more sophisticated as well, and they go further downstream to higher value chemicals, not just your basic chemicals and polymers, all tied to this net zero push by 2060. It's the tech clusters, right? And it's manufacturing in general, that they've got all these experts, all these scientists working together in a virtuous hub of expertise in places like Shenzhen. Extraordinary innovation, not just in green chemicals, but in AI as well, for example, and robotics. So I think the mega trend is China dominating high value manufacturing, including chemicals, in green chemicals. And next slide, please. And I think, you know, looking at the sort of broader picture now, I think we're going to see the commodity game really back, you know, dominate, always has been, but increasingly dominated by the state-backed commodity giants, the state-owned players, the Aramcos, right, the SABICs, the integrated players dominate petchems even more. As Will said, the Middle East is adding capacity, crude oil to chemicals, maybe after the end of the decade, but that could happen long term, and big scale crude oil to chemicals, the breakthrough technologies, right? Lots of natural gas liquid discoveries in the kingdom, which gives them more feedstock, right? And then in China, it's expanding in China, Aramco expanding in China, placing their crude oil into refineries and taking advantage of the engineering state, China's ability to build this stuff on great scale, great integration, great efficiency. So it will be the state-owned companies. If you're a middle player, a middle commodity player, mid-sized commodity player, you will struggle in this oversupply market, right? Or you can pivot to specialities or specialties. It's a hard shift to make, right? Again, you need tech clusters. You need lots of R&D experts together, like BSF, lots of PhDs in chemistry working together. So scale matters in specialties, right? And scale brings capital. You know, you need sustained capital investment to replace those stuff that go off patent, new ideas, new formulas coming through all the time. And just that schematic, that diagram, by the way, is from our training courses. It shows the fundamentals of what drives the commodities business, feedstock advantage, integration, etc. But for, you know, go to specialties, it's different, right? It's different. Next slide, please. Getting towards the end, we'll take some questions. And just the risk when you're moving downstream, and it's one of those things that people have talked about incessantly for years, right? That today's higher value chemicals often become tomorrow's commodities, right? And going back onto that China theme, really extraordinary the way that China's quadrupling the number of grades of polymers it's making at the moment, quadrupling, right? It's not just making homopolymer PP, it's making copolymer, it's making higher value PP. It's going downstream into higher value chemicals, into specialties as well, because there's massive state backing. Can you, if you've pivoted specialities as a medium-sized player, can you compete with that state funding? And scale really matters. Concentration of talent. So the mid-sized chemical companies can't stay in commodities quite often. Can they survive by going to specialties? It's a real big question for me, right? I mean, you can partner with China, right? I mean, that's the key thing. You want to be inside the tent, as they say, rather than outside the tent. So you invest in China in sustainability, right? And the chemicals and polymers that go into EVs, into green buildings and renewables, etc. Because China, as I said, will dominate green chemicals, I think. So maybe that's your path, right? As I said, that subplot of the Middle East, we need to look at the NGLs very carefully, and oil to chemicals. Do they stick with low-cost commodities, or they twist towards higher value segments? They want a bit of both, actually. I know that discussion, we had the GPCA conference in Bahrain in December, and people were talking about that. Do we just do basic low-density polyethylene, or do we do EVA, LDPE, a bit more complicated, or do we go further downstream? We've got all this extra feedstock. We need to take those feedstock allocations and do something with them. Do we do the basics? Do we do something more complicated? And that's the discussion taking place right now in the Middle East, and there's quite a few new projects that have been announced. It'll be interesting to see what happens. I mean, and again, which high value chemicals will remain differentiated and for how long? That's the key question when we talk about specialties. So that's my last slide, I think, Nina. Yeah, well, I really have to talk about this, don't I? I'm sort of swinging around all over the place about AI. I think on one moment it could be completely transformational. Next minute, I'm not so sure. If anybody claims they know and are certain, I think they're being intellectually dishonest. We really don't know, right? Huge amount of investment is poured into AI. How much of that is going to be wasted? We end up with a stock market correction. We've seen that recently. At the same time, software companies have been hammered by AI taking over their functions. But just to sort of think about chemicals on this slide here, it's another mega trend. It's a crisis navigator, right? I was playing around with ChatGPT the other day on the train, typed in, can you give me a work day for a chemicals analyst, and how that would change. And it was quite astonishing about the work that a chemicals analyst could save by automating a lot of the data crunching, building dashboards, building new ways of looking at chemical markets. And of course, the chemical companies are doing this, right? They're saving on costs, trying to improve efficiency. Can you factor in things that are very hard for humans to factor in, like weather, geopolitical risks in complex modeling, which is not really possible. It is possible, but extremely difficult using our computing power, intellectual power. But that we have to guide AI, right? It's still very much a junior research assistant, or at least I feel it is for me at the moment. But then we could say, okay, can we go further than this downstream development? Can we develop new composite materials using AI, identifying new composites? You still have to trial them in the real world, right? You can't just use AI and then come up with a new composite. You have to make it work in the real world. But will it help you identify composites more quickly than is the standard approach? It can be quite slow. Operational efficiencies in around chemical plants, transfer of heat and energy, etc., and avoiding shutdowns. One of the CEOs I was talking to last year said, will shutdowns become a thing of the past as AI monitors every valve to make sure it's replaced at precisely the right time. Every stress point in a steam cracker, we know that. We can find out the stress points and avoid unnecessary shutdowns. All of these things to think about. And referring back to the beginning, cost savings in employment, where you don't need people to do the basic data crunching. It's done by the machines. The question then, of course, is if you don't have junior analysts coming in doing the data crunching, how do they become senior analysts? That's the question. Real problem in terms of expertise in the chemical industry then, but that's happening across different industries, isn't it? Big dilemma. Procurement. Can we improve procurement through using AI, make it more automated? And of course, sales as well. Well, we're not involving a salesperson, but it's two bots talking to one another, which comes up with a basic sales contract. May not really complicated sales contract, maybe spot sales. Contract sales, you probably still want people involved, right? A very complex structured propylene contract in Europe, you wouldn't trust AI at this stage, but maybe the odd spot sale, yes. So that's how I see the world at the moment. It's all very complicated and interconnected, I think. But challenging times, difficult times. But I do feel, in terms of capacity closures, in conclusion, that I think this year could be the turning point. We get to feel slightly more optimistic than I even did a few weeks ago, just because of the scale of what we're seeing announced, and particularly around China and the older plants. But let's wait and see. Hopefully things will pick up a bit quicker than 2036, certainly, which is that very disturbing chart on propylene operating rates, which applies to lots of chemicals and polymers in our forecast. Very low operating rates next decade for most of the products we cover. Thank you. I'll take any questions.
Yeah, thank you, John, and thank you also, Will, for intriguing insights. I'm glad you closed on a little bit of an upbeat sentence at the end, because otherwise it fitted our nice weather here in Brussels on a Monday morning. And in fact, a lot of questions came in, so let us see that we can accommodate at least a couple of them in the interest of time. So first question, and thanks to the audience who sent those. First question is actually to John, just linking into what you just said about China. Don't you think that Chinese politics is able to combat the aging of the population by subsidizing more children families significantly?
Well, you've got to wait for 20 years. Dorothy, before it actually produces an economic benefit, so it's 20 years away.
Yeah,
before they join the working population. So it hasn't worked so far. I mean, the births per woman have fallen below 1 in some parts of China, which is catastrophic, literally catastrophic. It's about 1.2, I think, 1.1. It'll take a long time to turn that round. My answer to that, I think. But yes, they're trying. They're certainly trying.
Yes, they have introduced measures to encourage
exactly
larger families, haven't they?
Yes. That does not work so properly, I guess. I understand. Yeah. Okay. Thank you for that. Then 2 questions on the gas prices, actually, I think for Will. First question, you project backwardation in European gas prices. What do you expect on domestic gas prices in China? And can this improve European competitiveness in comparison to China? So it's actually a question to both of you.
I'm afraid I'm not an expert on gas prices in China. I think they're very competitive at the moment. I don't have a forecast for it, I'm afraid. John, do you know anything about China gas prices?
No, I'm afraid not. We can certainly check with our colleagues there, can't we, Will, and get back to the person who's put the question, get your details, and we'll certainly reply. Okay.
Yeah, there is some interest in those gas prices. There's another one. This one is really for Will then. I want to understand your gas price forecast. What is the basis? Why do you see a continuous decline in the next 4 years?
It's all to do with these additions, these LNG, liquefied natural gas fields are coming on stream in Qatar and in the US, and so there's going to be a lot more supply globally of natural gas in its LNG form, and that's just going to reduce the sort of supply demand imbalance. There'll be more supply. Demand's actually quite depressed at the moment, and we don't see a big uptick in demand. So I think there'll just be more supply, flat demand, and therefore the gas price is likely to drift downwards. But we're not sure by how much, and we don't know whether it's going to be enough to really turn things around for Europe based on the global gas price.
Okay, thank you. Then again, back to China. I guess you have answered that already, John, in your presentation, but nevertheless, on your China capacity expansion figures, what's your view on anti-involution measures and orchestrated capacity reductions in China? How did you account for this in your projection?
It was that Will's, I think it's your chart, Will, wasn't it, for capacity? I didn't, in terms of the global propylene charts, it's up to date as of sort of late last year, Dorothea. So we're taking into account quite a lot of propylene ethylene closures in China. We are assuming quite a lot, right, on that propylene chart. And Will had a chart as well, didn't you, about China's capacity dominance. So we're assuming quite a few million tons will shut down. So we're assuming some of the smaller propylene, refinery-based propylene plants, for example, will close down, right? But they're still pressing ahead with PDH in a big way and steam cracker propylene. We're assuming also that gradually over the next 20 years, the coal-based chemicals will gradually be consolidated for environmental and economic reasons. So that's all factored in, anti-involution, because that chart was updated as of late last year.
Yeah, I mean, the perception's been so far that the scale of closures with this involution strategy is dwarfed by the amount of capacity coming on stream. And actually, we in our magazine, every week we publish a thing called the new project summary, and it's still totally dominated by new projects in China. So although they're closing a lot down, they're planning and starting up far more. But it's interesting, John, that you're feeling more optimistic about a turning point in the capacity imbalance this year. That's very interesting.
I just think it has to happen, Will. Yeah. Maybe it's more of a gut feel than anything based on the data, but I just think that, well, you see quite a few announcements anyway, right? And I think, people look at these charts and think, well, we can't let these operating rates stay low for so long, can we? This can't happen. You can't have 23% operating rate average to 2036. It's not going to work, is it? Right?
Yeah.
And I think that's the reason why I'm feeling slightly more optimistic, I think, yeah.
The CEOs are making tough choices, aren't they?
Yes, I think that they are. They're having to, yeah. But I just say on an optimistic note, the opportunities around the developing world outside China are amazing, right? Because that will become the main demand growth driver. It's the Middle East, it's India, it's Indian subcontinent, it's developing Southeast Asia, Latin America, right? Africa, huge opportunities of growth there. And that will gradually kind of take over importance and replacing China as the main growth driver. But that'll take time.
And that's what that free trade deal between the EU and India, I think that really could be quite significant in years to come, as you say, John, with that market blossoming.
Yeah,
indeed. We have 1 minute left. I would like to conclude with one last question and asking you kindly to keep your answers very, very short. Actually, just linking in what you just said. Do you believe the relocating of European plants to Middle East would be the solution where the energy and feedstock is cheaper?
Well, there are actually some examples of European chemical plants where they've literally dismantled them and they're reconstructing them in the Middle East. I think there was one that we reported on ICIS News recently. So yes, it is possible. Yes, and obviously, you saw that graph with the gas prices. The gas price in the Middle East has increased slightly, but it's still highly competitive. It's still a really cheap place to make chemicals. So yeah, I think that trend will increase. John, anything to add?
Yeah, but I guess again, we've talked about this before. Do we? I mean, Europe needs a chemical industry, right? and it creates lots of jobs downstream. So is that the right thing to do from a sort of geopolitical, economic perspective? Sorry, that's broadening it out, Dorothea, but talk about feedstock advantage, but what about supply chain security? Yeah.
Exactly. That alone could fill another webinar together. Open to do another one. So for the moment, in the interest of time, and I know there are some questions left which we could not answer right now, but we have to conclude. So by first of all, many thanks to you, Will, and to you, John, for being with us, for sharing your fantastic insights with us. To everyone in the audience who took time to listen in on a Monday morning, to Nina, who ran the show so smoothly in the background, and to everyone who submitted so fascinating questions. So I'm pretty sure this is not the end of the discussion, and the insights shared today will certainly give us food for thought also for the next weeks and months, where the situation doesn't seem to become so much better, as I understood. So, and if you're interested in more of this, and of course, a broader context of all the topics that we just scratched in the last hour, then I warmly invite you already now to save the date for later this year, to be precise in mid of September, when we are hosting our FECC annual Congress with an international setup, a lot of networking opportunities, plus an established contents. So be with us between 14th and 16th of September this year in Vienna. And we also have other nice webinars on stock in the coming months. So for today, many thanks. Take good care of yourselves and stay tuned for more. Thank you. And thanks, John and Will. Take care.
Bye.
Thank you.
Thank you, Dorothy.
Thank you.
Bye, everyone.
Bye.
Thanks.